Carlyle just acquired one of your competitors, Churchill. What are your thoughts about that?
So Churchill certainly was a big competitor. In fact, Churchill was $1.3 billion CLO that was supported by not so much equity, and they sort of didn't work because of too much leverage. And Churchill was a major competitor of ours 2 and 3 years ago, and they hadn't been the last year or two. But the culture is really good. It's a great purchase for Carlyle. It's a great way into the BDC sector. But it's also really good for them to have the scale, as it's rumored that they're going to have a public BDC in the next couple of years, alongside TPG, who's announced the same thing.
How will new entrants like Carlyle and TPG change the dynamics of BDCs?
Well, the important thing in any sector, whether it's financial services, especially as you have institutional buyers like Wellington, Fidelity, T. Rowe Price, and others, is to have enough market cap and liquidity in that sector and enough comparables of reputable firms. So while I would normally be very upset about a competitor entering the market, like if, for example, did New Mountain, when they went public, help us? Absolutely not. They're another competitor entering the market. Here you have two name brand players that are not going to come in at $200 million. They're coming in at $1 billion in size, which adds enormous amounts of market cap, but also brand name recognition to the investor base. And now you have a sector that may be more widely followed by analysts, for example, be more widely traded. The indexes that are linked to it, like the UBS index, now will have two major components with more liquidity. So I think it's a real positive for all business development companies to have players like that enter.